What is the cost of all the sugar high? If you're, as I kind of alluded and talked about last year, when they pump money into a system, at the beginning it all feels good because it takes asset values and starts to rise asset values. And everybody likes seeing their stocks go up, their real estate go up, their bond holdings go up. Everything starts to rise. But the problem is, once you pumped all that money into the system, it doesn't stop there. That money starts moving and circulating out of the capital markets as well. And now you're having to start, as years go on, deal with the consequence. And what are we dealing with now? Inflation. Inflation we really haven't had to deal with for 40 years. Inflation, folks, and I'll get into it, is a monetary issue. Because if you think of an economy as it becomes more productive and becomes smarter in how to operate, and technology advancements will always be deflationary. I'll give you the best example. Go back 100 years, and you owned a farm. How did you farm and produce your goods, your produce, whatever you were growing? With a horse or a cow and a lot of manual labor. Then what happened? Tractors came along. Then more modern agricultural practices, fertilizers. Now what one farmer can do and how much they can produce is unbelievable. That's all deflationary. That's what an economy, as it gets smarter and better productivity, will always create. Inflation is a monetary issue. So where are we with inflation right now? This graph goes back to 1958. On the left is CPI, Consumer Price Index. On the right is PPI. That doesn't go back as long because we don't have the data set for PPI. And that's the Producer Price Index. CPI looks at the cost of all goods for us as consumers. Producer Price Index is the cost of all goods for businesses that produce goods. As you can see, you had this terrible spikes in CPI that started in the late 60s and then rolled through the 70s. Because back in the late 60s, President Johnson created the Great Society. They spent ungodly amounts of money. They started increasing the money supply too much to deal with all that spending that they did. And then Paul Volcker and President Reagan came in, and they broke inflation. It was a very painful thing to break inflation. They had to take interest rates to 18, 20%. Anybody old enough to remember it, it was a horrific recession starting, the economy was just dysfunctional by the end of the 70s because of all the inflation. We had bouts of stagflation, which I'll get into. But then as we moved into the 80s, inflation started to come down because Volcker and President Reagan broke it. And for the last 40 years, we really haven't had to deal with it. But now, it's on the move in a very meaningful way. Now, the Federal Reserve is saying it's transitory, it's temporary. Here are their reasons. The spike in consumer demand and spending will recede, relieving pressure on supply chains and freight rates. Okay. Labor shortages will clear as excessive government transfer payments decline. Okay. Supply chain blockages will eventually clear, creating more supply of goods. Eventually that will get cleared through. And then lastly, China's economic growth rate will continue to slow as the property market collapses from excessive leverage, which will slow the demand of commodities globally, further relieving inflation and supply chain pressures. Okay, so those are the arguments that the Fed is making and many people are making about, don't worry too much about inflation. It'll go away. Here's some examples to support their arguments. This is lumber prices. Lumber prices before the lockdowns were at $460 for 1,000 board feet of lumber. all of a sudden, because the mills were shut down and home building was continuing because people went off and started buying homes in a massive way, lumber prices skyrocketed, almost went to $1,700. I had a couple multifamily projects that I literally said, we're not building. The added costs to build these buildings are just destroyed my economics. And a lot of other builders did too. And then all of a sudden, mills opened up and things started to come back down. Now they've had a bit of a spike back up again, up to $573. But this is probably one of the biggest arguments you'll hear the people talking about transitory. Another one is transportation costs. The index on the left is the Cass Freight Index. What's the Cass Freight Index? It's a function of trucking, shipping, and rail. As you can see, the cost is just skyrocketed. And then the one on the right is container pricing. So the containers that these big ships come in, they've gone through the roof because everybody's trying to get their hands on containers. Now, the argument for this is once all this gets kind of flushed through the system, the pricing for a lot of this will just drop back down. And then lastly, labor shortages will recede. Because the federal government was paying people more not to work than to work, we created massive problems with labor and businesses not being able to run their factories to produce the goods to relieve some of this pressure. The government transfer payments went up to $5.1 trillion. Now they're down, but with what President Biden is talking about, they want to continue to, with Build Back Better plan, continue to juice and supercharge a lot of the transfer payments, welfare payments, however you want to say it. Arguments for why inflation will be structural. Remember what I said last year. Inflation is almost always a byproduct of fiscal and monetary policy. You produce more dollars, you got more dollars chasing the same amount of goods. And let's look at it. I could take this graph, and I did last year, back to the 1880s. We have never had a time in our country's history where we expanded our money supply at the rate that we have. Last year, we expanded our money supply by 27%. Most years, the money supply will expand by 2, 3, 4, maybe at bad times 6% to try to juice things. 27%. They're still expanding the money supply by 13%. Now think of that. You've had a 40% expansion of your money supply. Well, you've just added 40% more currency dollars into the system. We haven't produced that many more goods. So you're getting a bid, and it's driving inflation. That's why I believe it's structural. Let's take a look at commodity prices. Other than gold, which is a very interesting dynamic because usually gold performs the best during inflationary times. Why is it not this time? Because everybody's pouring into crypto. I think gold's going to have a great run at some point when crypto gets cracked. But other than gold, all these commodity prices have skyrocketed. I pulled out some of the metals: copper, steel, lithium. Look at these movements, both year to date and their gains since January 1 of 2020. Lithium, that's because of all the batteries, 288%. Then you look at agricultural goods. This is what's impacting people's pocketbooks. If you are an older person that are living on a fixed income, or you're a middle or lower income person that don't own a lot of assets, you're getting hammered. I mean, utterly hammered. Your food prices have gone straight up. Look at coffee, 63%, corn, 47%, cotton that goes into the making of so much of our clothing, 70%. Palm oil goes into so many food products, 62%. Sugar, 48%. Wheat, 40%. Now look at the industrial metals: aluminum, cobalt, magnesium, nickel, palladium, tin, zinc, all of them ripping. We have a real problem with magnesium right now because we get most of our magnesium from China, and they're restricting it. So this thing's going to continue to move, and you can't make aluminum without magnesium. So watch your prices. They're just going to keep moving. And then lastly, livestock. Beef, 26%. Lean hogs, fortunately that's lower, 3%. And poultry, 51%. Now let's talk about housing. Inflation has hit housing in a massive way. And it was a perfect combination of events. First, you have millennials reaching home buying age. You took interest rates to zero, lowest interest rates we've ever had. And then you've had a lot of people that were living in apartments in downtown LA, San Francisco, and all over New York City, and they wanted to get out. They wanted to either get to their suburbs, or they wanted to move to places like Boise or Salt Lake or Arizona or all these different markets. And so we've had housing just skyrocketed. So before the pandemic, the average housing cost was $375,000. It's up to $434,000. Now I know all you Californians who would say, "Oh God, is that cheap?" You know, that ain't much. But if you're living through most of the rest of the country, that's a lot of money. And you know what's sad about this? It's really impacting our young people who are trying to start a family and trying to get out and trying to buy a home, and they're having to leverage themselves up so much. And we've just created another housing bubble. Now let's look at housing prices a different way. This is the Case-Shiller Index, the one in blue. HFA Home Price Index in red, both up. This is year over year, 20%, 17%. Now what's this gray line? CPI shelter. Why is that 4%? Whatever the government tells you CPI is, don't believe it. It's a lot more. We're the only government in the world that does something called hedonic scoring, which I'm not going to get too deep into that concept, but if you improve a product, they don't factor in the price increases, basically, to sum it up. But there's a lot of other games they play. Shelter costs are 33%. It's the biggest component of CPI. And what they're saying is inflation has only moved up 4%. But we all know housing has moved up far more, because every other index that you can validate has moved up tremendously more. Again, 20% year over year. Look at, total home average selling price. I'm going to get into explaining why. The government moved to something called owner equivalent rent. Instead of tracking the sale of homes and saying this is what home prices have done, they now do a survey that basically asks you, how much do you think you can rent your home for? They do it twice a year. So under owner equivalent rent, which is the biggest component piece of shelter, the other two components of shelter are rental costs for multifamily and lodging away from home, which are student housing and hotels. That's all shelter costs. But the biggest component by far is this OER. Folks, trying to measure inflation by calling people and saying, what do you think you can rent your home for? Most people would have no clue. Okay, I think I can rent a little bit more. But what's going to happen as we go on? That line's going to finally start catching up. So the inflationary numbers are going to start showing what real inflation has been. I think inflation it's not at 4 some odd percent, 5% like the Federal Reserve and CPI saying. I think it's running 7-8% easily. Now let's go to another reason why inflation is going to continue to get fueled. Energy prices. Think of all the things that energy goes into. Making of products, the production of products, the movement of products, the movement of all of us, our cars, our planes. Energy cycles into everything. We had the greatest benefit for 15 years that started at the end of kind of the late 00s where we had this thing called fracking that was technology advancement that boomed our energy production. And let's look at that. So this is West Texas Intermediate crude and Brent crude oil. As you can see, you had this massive spike up in 2007, 2008, as the Federal Reserve was pouring money, creating inflation in fuel costs, sending it up. A barrel of oil went up to almost $140, almost $150 with Brent, and then it came collapsing down and then continued to head down. Why? Look at the nat gas prices, the one into the upper right. Nat gas prices came cratering down because what was happening in the Permian Basin in Texas and New Mexico and what was happening in the Bakken in North Dakota. And so we became energy independent. We were starting to export energy. Problem is now, because of all these ESG goals, how many of you know what ESG is? It's this thing that the government has been pushing and big institutional investors like BlackRock have been pushing. ESG is environmental, social, and governance, and requirements on companies to adhere to these different standards. It may be governance. You have to have a certain amount of females or minorities on your board of directors, and social. It could be an environmental. It's forcing all these companies, big oil companies, all the rest, to underinvest in the production of fossil fuels and invest in green energy. And what is done also is the capital markets, they're not flowing money to our energy complex. So it's being starved of capital. So we have less wells being produced. And then you had President Biden. What was the first thing he did when he came in? He canceled the Keystone Pipeline, canceling other pipelines. By the way, that's insanity, because if you want to save on energy, oil, move it through a pipeline. It's safer and it's less costly than having it being shipped by truck and train all over the place where you get a lot of spillage. But that's what they've done. And now, where you have utilities that can't even get enough nat gas, they're starting to go back to using coal, which is the dirtiest of all kinds of fuel, and look at what's happened to coal prices. I'm telling you right now, one of the easiest bets in my book is that oil is going to go over $100 a barrel, very easily. I don't know when that is, next 3 months, 4 months, 6 months, depends how cold the winter is. But energy prices are going to continue to grind higher, and already these moves are going to continue to cycle in to CPI and PPI. These are gas prices. Look at the red line. This is what's happening with gas prices. Nationwide, it's $3.39. Now let's talk about utility rates. This is by PG&E, Southern California Edison, and San Diego Gas and Electric. The dotted line, up 20%, is CPI. This has been going on since 2013. Look at the rates of inflation of this area. It's unbelievable. And why is San Diego Gas and Electric so expensive? They shut down a nuclear power plant that was totally functioning. They decommissioned it. By the way, if you're worried about carbon, nuclear plants don't produce any carbon. Yeah, there's, nuclear waste, but there are people that argue, Bill Gates and others, that will say we should absolutely be moving vastly more nuclear if we're concerned about global warming. So San Diego and California have the highest electrical costs in continental United States, and San Diego the highest in the state. Interesting, though, solar may be a remedy, a helpful tool for those who own properties or own a business. Let me explain why. Economics of a $1 million solar investment. If you build a solar system for $1 million, you immediately get an investment tax credit of about 26%. It depends. This is for corporations. It depends if you're individual and how you're doing it. but you get this big solar green energy tax credit. Then you get a bonus accelerated depreciation of basically 18%. So day one, year one, should I say, you make $1 million investment, you're getting back almost half of your investment. Then, depending on the cost to build the solar system and what your energy rates are, obviously you make more money in San Diego than someplace here like Orange County where average utility kilowatt costs are about 14 cents. So San Diego is even more profitable. But your year one savings are about $115,000. So you're generating right off the bat a 21% return. But here's the other big benefit. Because the state is so messed up, we're having brownouts. And guess what? For a lot of businesses, that's not good to have brownouts. It shuts down their factories, or if you have refrigeration or things of that, you have to throw a lot of your products if you're down for too long. Unless you want to run generators, which a lot of them have had to build. So it helps secure your energy. Secondly, who knows how much these things are going to move? If you can start capping a percentage of your energy costs year over year, your returns may go off the chart. So we've gotten into the solar lending business. Hey, James, come on up here for a second. If you're interested in talking about solar, we will finance it. We will do a lease structure with you. Or we'll actually own it because some people can't use the tax credits. So if anybody wants to talk to James about solar, this is the man. So you can see him and grab him outside, all right?
Thanks for the pitch.
Hey, no problem. Got to make a pitch because honestly, folks, solar, I don't want it. And then I started getting into it because originally it was just all a tax game. But then I started looking at it because what happened to all these utility costs. I'm like, no, we've got to do this. And it's definitely worthwhile investing and looking into. All right, so where are we? Here are the inflation scenarios that will play out. Is it transitory? People argue it has or is already peaking. Is it structural, where all costs, including salaries, continue to rise? Everything just continues to move up. Does it turn into stagflation? Persistent high inflation combined with high unemployment and a stagnant demand in the country. That's what we had in the late 70s. And eventually, if inflation keeps moving, it will always end up in stagflation. Why? Because if salaries move too much, then businesses' margins start getting collapsed. They start investing less, and then labor starts getting laid off. If price of goods moves up, but salaries don't move up, people can't afford. They move out of apartments. They move in together, kids with their parents or parents back with their kids. They start spending less. So eventually, structural inflation almost ends up always in stagflation. Or do we all break into deflation because of the massive amount of debt that we just can't continue to carry it, and at some point the economy rolls over and then everything just craters down? Look, politicians and the Federal Reserve have created what I call Pandora's box. The red is our U.S. debt. As you can see, our debt levels to our GDP was pretty manageable up until the great financial recession. Averaging about 40, and then started moving up to 60%, and then just kept moving. We have been so fiscally irresponsible over the last 15 years, it's been mind-numbing. And the problem is, now our debt to GDP has exceeded our GDP, and now we're at 125%. Once any economy does that, they enter in what is called a debt trap. And once you're in a debt trap, there's only two ways out. One is default, which many, many countries do. Think of Argentina, think of Southeast Asia back in the 90s, Mexico. I mean, most of Latin America is defaults at some point in time. Many African countries, many Asian countries, Eastern Europe, all gone through default. Problem is, U.S. government can't default. Because if we default, we create ourselves into a depression that will go on for decades. So what is our option? We only have one option, and that's we're going to continue to inflate. Now, what are these two lines? The red line is our interest expense and our pay-goes, Medicare, Medicaid, Social Security. Those are entitlements. The blue line is our federal tax receipts. Folks, where we are right now, what we're spending on entitlements and just the interest costs of our debt exceeds our total federal tax receipts. And by the way, we've had a boom in federal tax receipts. One of the reasons why the Federal Reserve is pumping up all our stock market so high, because it creates more activity and higher valuations, creates more tax revenue. But we can't even match that just with the things we have to pay. Now, let's add this on. What that line is, that's just the cost of operating government, our Defense Department, Health and Human Services, HUD, Housing and Urban Development. We can't even cut. You could annihilate all of government where we don't even have a Defense Department. We're still spending more because of how big our entitlements and how much debt we've wrapped up than what we're taking in. What does this mean? The Federal Reserve is going to keep printing money. That's all they can do, is keep printing money. Now they're talking about tapering. They will taper. But if all of a sudden rates start going haywire, they're going to come right back in and start buying bonds and monetizing it. This is the Treasury maturity schedule. The first bar is what they have to roll this year, fourth quarter of this year, which is almost $3.5 trillion. And by the way, the red is what the Fed owns. The blue is non-Fed. Other governments, us, our institutions, foreign institutions. Next year, they have to roll almost $4 trillion. We got to roll $6 trillion of debt next year. This is going to have huge implications, particularly when they start tapering, because now you're going to start draining some liquidity out of the system. They're still adding a lot of liquidity to the system, but soon it's going to start draining. That's why I showed you all the stuff with the equity markets. Be careful with your investments. This is the yield curve, the Treasury yield curve. The red line is the 10-year Treasury. It's at 161 basis points. And then that's the 2-year Treasury, the blue line. It's at 46 basis points. 2-year Treasury is almost doubled. As these inflationary pressures continue to build, people are projecting that the Federal Reserve is going to have to lift short-term rates to stem inflation. How does the Fed, how does any central bank break inflation? By raising interest rates, slowing the economy down, and cracking inflation. The problem we have, that is not a tool they can use very easily anymore. Why? Because every 1% increase in interest rates adds another $290 billion of interest costs. So they have to keep rates way artificially low. Rates should be much higher than where they are today. Much higher than where they are today. Now, the Fed can always control short-term rates, but they have a much harder time controlling long rates because they've expanded their balance sheet and buying so much, they've been able to do it. But if they start moving out of the market, they're going to have a harder and harder time. Now, this is what's happening. It's called financial repression. This is what central banks do to take care of their biggest client, the federal government. It's a backdoor tax, inflation is, number one, and two, they're giving you negative yields for buying their debt. So, blue lines, the 10-year Treasury, you're getting, the red lines, the U.S. Treasury, you're getting a 160 yield. Inflation is moving at 4%, So what is your effective real yield after inflation? Negative 2.4%. That's what you're losing every year owning a 10-year Treasury bond. So, folks, we are in the everything bubble. There's many graphs I could go look at to show you this. I like this one. This is Warren Buffett. It's called the Buffett Indicator. And its measurement is to determine whether the equity markets are overvalued or undervalued by looking at the total value of the stock market to US GDP. Typically, as you can see, this goes back to 1971, the stock market value a little bit below, at times higher. That was the internet bubble in 2000, 2001, where it peaked up, but pretty much tracks GDP. You had the great financial recession, went way down, then kind of came back, and as the Fed kept expanding its balance sheet, it kept moving higher and higher and higher. Now, we're at 207%. We're so wildly overvalued, and you can look at almost any asset value. That is the case. So, I like to say, and I've heard others say this as well, so it's not some big revelation by me, but printing money does not fix excessive debt. What does it do? It delays the problem into the future and passes it on to our children. That's what we've done. We pulled everything from the future, loaded ourselves up with a lot of debt, and now we're going to have to deal with it, but largely our younger generation, our kids, are going to have to deal with it, or our grandkids. It transforms the problem into currency devaluation and trade wars. That's already started. All the world trying to manipulate their currency lower to generate greater export growth and economic growth. And lastly, it transfers the problem into inflation, asset bubbles, and inequality. I find it ironic that the very people screaming the most about inequality are the ones who have created it the most. Because their policies, oh, we got to give more money, we've got to spend more money at the federal government. They don't even understand that by doing that, the central bank has to go in, flood the system with money. Well, who benefits from it? It's people that own stocks, real estate, assets. If you don't own assets, you're getting hammered. So that's the heart of the inequality that's happened. You know, you've made Jeff Bezos and Elon Musk hundreds of billions of dollars. But the average guy, the older person living on fixed income, they're getting clobbered.